Hello, everyone. Thank you so much for joining in. Welcome to India Factoring Chat Show. Factoring, one stop solution for your global aspirations. I'm Vinod Vasan, your host for the day. Today, we have two eminent speakers to join for the show. Before that, let me take you through India Factoring first. India Factoring offers working capital solutions through the factoring product aimed at converting your receivables into cash. The company is a subsidiary of a European bank, Fimbank PLC Malta, and is recognized with the RBI as an NBFC factor. India Factoring is also 83 category authorized dealer. Through our global network, we offer one-stop solution around receivable finance. Today, our eminent speakers will talk to us about factoring, supply chain finance, market trend, etc., and solve all your queries pertaining to global trade, financial aspects of your business. Please stay tuned. Let us welcome our first speaker, Michael Bickers. Michael is Managing Director of BCR Publishing Limited. BCR Publishing is the world leading provider of receivable finance news and intelligence. Based in London, BCR delivers to the global receivables finance sector through books, online news, and events, and has been doing this for more than 25 years. Michael is author of 12 editions of Factoring in the UK, editor of 25 editions of the World Factoring Yearbook in association with FCA, editor of the World Supply Chain Finance Report, editor of Equipment Leasing in the UK, editor of Venture Capital in the UK. Michael views, opinions, and findings have been printed in leading newspapers and journals, including the Financial Times, the Sunday Times, the News, the Daily Mail, Daily Telegraph, Director Magazine, Accountancy Age, Business Age, Chartered Banker, Investor Chronicle, and Export Today, and whatnot. Welcome to the show, Michael.
Thank you very much. It's a pleasure to be here, and thank you for inviting me.
Let us welcome our second speaker, Ravi Velecha, CEO, India Factoring and Finance Solutions Private Limited. He's an experienced banking and financial services professional with experience in factoring and supply chain finance, and current CEO of India Factoring. Welcome to the talk show, Ravi.
Pleasure to be here once again. Thanks.
Hi. Yeah. So let us get into the discussion. Start with Michael. Yeah. Michael, in the last 3 years, global economy and the geopolitical situation is changing so uncertain, and conflicts in Europe, pandemic and trade wars and recession, etc. So it is important that all stakeholders of global trade who are involved in global trade, sellers, buyers, financiers, should monitor the impact and consequences of supply chain finance to ensure sustainable supply chain finance. So please give us a brief on a current geopolitical situation, global economy, and impact on the global receivable finance sector.
Thank you. I suppose really what we're looking at the moment is, perhaps rather unfortunately, it's a period of uncertainty. That's the one word I think I can use to summarize the current climate and current situation. Just to kind of look at how we've arrived at that over the last 3 years or so. Prior to the pandemic, we were faced with trade wars and supply chain issues and supply chain disruption and changes, which the receivables finance sector were trying to cope with. And then all of a sudden, in early 2020, we were hit by this major pandemic. And of course, this had a major impact on world economies, and so a major impact on the receivables finance sector. And as a result of that, we saw massive reductions in trade and receivables finance volumes over that period, and we entered into another period of uncertainty. So the world learned how to cope with uh, the pandemic, and we started seeing the introduction of vaccinations. We were beginning to see patterns in the development and progress of the pandemic and how the world was dealing with it. And during that period, um, businesses were not spending, consumers were not spending, but people had money, and there was a lot of pent-up demand within economies and within consumers. And as we saw the world coping with the pandemic and coming out of the pandemic, we started to see, and restrictions were reducing, and economies in the world was opening up again. We started to see a release of that pent-up demand, and sales began to increase quite rapidly. And that was reflected in the use of receivables finance. So we saw some very impressive bounce back volumes, if you like, in receivables finance, in factoring and reverse factoring. Towards the end of 2021 and beginning of 2022. And then, of course, early last year in February, we saw this conflict start in Europe. And that changed everything, and we saw, and are still in the middle of an energy crisis situation. A lot of support for Ukraine from Western markets, Western countries, and as we all know, wars are very expensive. So this has had a big impact on many economies, and so we haven't seen the figures yet for 2022 performance in factoring. They haven't been released by FCI yet, and we haven't produced our own publication where we publish our figures. The World Factoring Yearbook, Ravi is a contributor to the 2022 edition. So we're yet to see what the real impact has been, but it does look as if there is going to be a significant impact on the use of receivables finance in terms of volumes and funds in use. What we do have are some figures, preliminary figures for supply chain finance. Our World Supply Chain Finance report will be published in the next few weeks. And what we can see there is that although the growth rates in terms of use of reverse factoring, supply chain finance, the growth rates are still high and impressive, double-digit growth rate figures. That rate of growth has reduced quite significantly. So we were seeing rates of growth of 30 or 40% in the use of reverse factoring in terms of volume and funds in use from sort of 2019, even through the pandemic period, to a large extent, and 2021. But 2022, that rate has slowed quite significantly. So it's a difficult period, a period of uncertainty. We don't know when this conflict is going to end. I think personally that the world will learn to live with the conflict, and we will find ways of getting around the issues that the conflict has caused, energy issues, gas issues, oil issues. We'll find alternative ways of coping with that, and there will be a period of some settlement, I think, if the war continues. And I think after some time, we will see things improve, economies improve, and confidence coming back, some levels of confidence. And of course, if the war finishes, if the conflict finishes in Europe, then we'll see a quicker return to more positivity in economies and consumer optimism and business optimism. So that's where I see where we are at the moment. Overall, over a longer period and bigger period, yes, a lot of positivity for receivables finance. And but we're going through a difficult period at the moment. It's a blip, quite a lengthy blip, but we will come out of it and things will recover quite strongly. And if we see an end to the war soon, then that recovery will speed up, of course.
Right. Thanks, Michael. I actually gone through your factoring yearbook for 2021, so it was very detailed, and we can see the numbers how it has, the factoring and receivable finance sector has grown up in the 20 and 21 field. So probably, as you said, we'll wait for your 2022 book shortly, so we can understand more specific to each region specific. As you mentioned, we are learn to cope up with the current trend, and hopefully 2022 the world will be ready to manage any situation whatever we face. Yeah. Ravi. Here we have Indian export business majorly depends on US and Europe market, and we have noted few positive signs in the end of year end December 2022, that major retailers, international retailers, have liquidated their most of their inventories, and after 3 months of a consistent decline in sales. And retail business is always a key indicator for economy. And do you think it's a recovery for market, or and then do you think this same trend will continue in the year 2023?
Yeah, no, of course. Thanks, Vinod, for that question. Of course, we to set the context right. I mean, the numbers, what we are reading are too early. That the U.S. Retailers and U.S. economy is possibly bouncing back. Those are only the inflation numbers which have been shared by U.S. Fed. In fact, yesterday also we saw some announcement being made in U.S. Which led to quite a volatility in the markets across the world. So yes, it is early days, but definitely the Q3 of 2022 was really bad from a US and European economy, and that has a back-to-back impact from the now currently primarily from the war situation in Europe. Because of that, it had a big impact, and where the world is possibly, as the most economists across the world are citing, that the world is heading towards the recession, and due to the inflationary scenarios developing and the rising rates, possibly the spend of the consumers is reducing to a large extent. We saw that prevail till the Q3 of 2022. Normally, being in the India being more of a suppliers economy, manufacturing and suppliers to the largest of the buyers across the world. Exports is a key determinant of what is the demand scenario in major developed markets. What we usually see is a built-up of shipment and inventory and sales, possibly Q3 towards end of Q3 and Q4, primarily on the retail side, being starting with Thanksgiving and followed up with Christmas. This year has been an unfortunate time where the shipments have been largely delayed. So that's really, the understanding, what we understand from most of our export customers, is that there is a significant downfall or significant demand curtailment in both these geographies, US and Europe, across the world, and that has led to reduced consumption. Yes, over the Christmas period, possibly there was a last minute some revival, but of course Q1 of 2023 will determine where that is headed, whether that was a very small change due to the festive season, or whether that continues as a momentum goes on. Of course, the situation on the war will determine how things will change. And as Michael also cited, that if this war situation turns positive, that is, there is an end to the war and possibly the world can emerge out of it very quickly. But if this prolongs, I believe, and I again agree with Michael, that the world is evolving, and all these black swan events which we talk about, the pandemic and now the war situation, people are more or less getting accustomed to such black swan events, and what I call is a VUCA world, that is volatile, uncertain, complex, and ambiguous, right? These are all the situations which have been prevailing since possibly 2017 onwards, and these situations in the future also may continue. May not be as grievous as what we are seeing today, but definitely these are situations which is going to be prevailing for a longish period of time. So world will evolve and will learn to live with it and possibly work along with it. We saw during the pandemic, after the initial few months, people started adapting to the change. Nobody was used to living within the confined walls, right? People started adapting more. We saw people adapting to the online shoppings. So other things evolved, many other things evolved. And likewise now situation also people will evolve. The taste and the patterns may change, but I see that development over the next 6 months period. But definitely in the short term, there is going to be blips which we will factor in our growth projections also. I hope I could answer.
Yeah, thanks, Ravi. So, as you mentioned, so this may be it's a good sign that the due to the holiday and the Christmas season, good volumes picked up, and we need to wait and see whether the consistent sales is going on. So we'll wait and watch the markets for more information. Yeah, and Michael, can you share us major developments over the period since at BCR 30 years, and in particular over the last decade that have influenced the way that receivable financiers and are working today? Michael, I think he got some issue with. Michael, can you hear us?
No, I think he's stuck. Michael, can you
Yeah,
hear us?
yeah, he's back.
Michael, you're on mute.
Michael, you are on mute.
Okay. Now can you hear?
Yeah, can I repeat the
Okay.
question?
Okay. Apologies. Yeah. So just Ravi, I'm not sure if I heard the very last bit of what you were saying, but yeah, I mean, I agree. People's immediate reaction, businesses, consumers' immediate reaction to something like what's happened last year in Europe with the conflict is, let's be cautious. Let's be cautious about spending, investing. But as I said, and as Ravi said, after a while, people will become accustomed and will learn to live with these situations, and we'll see a gradual return to some sense of normality. But of course, if the conflict finishes, then we'll see a more rapid return. So, it's not things won't be as bad as they are now.
Great. Thanks, Michael. Yeah, Ravi, there is a trend globally, we are seeing, especially in India, post-pandemic, that exporters are very keen to tie up with the factoring and SCF arrangements. And what influenced them to realize importance of factoring and SCF products during the pandemic?
Yeah, few things. We saw at the start of pandemic, that was in early 2020, where the risk perception changed dramatically. One was that the risk perception from an overnight, possibly over a quarter period, it changed from everything in 2019 was normal to a grave risk scenario across the world, where people didn't know how to tackle with the pandemic, and people were talking about catastrophic situations because of pandemic. So the world took its time, and that's where the risk perception across the PDs of the world and the LGDs, all those things, the modeling, the risk modeling, overnight turned very, very premium, right? So that was the risk perception, and because of this, also possibly people wanted to curtail or mitigate and bring in all the mitigants possible to bring to their balance sheets, and that's why factoring, which brings in the credit protection angle, and the credit insurance, that increased, and that's why people wanted to go for factoring. The more important part was because of this pandemic situation also there was and banks perception on the risk also reduced and appetite reduced to a great extent, and that's why we saw the credit offtake reducing to a great extent. Now, because of that and because of which also the leverage position of the companies across the world started increasing to that extent, and people realized that relying on the traditional modes of finance through loans, through other overdraft mechanisms or whatever be it, it's a balance sheet heavy exercise, which leads to the contribution of leverage being created across corporate sector. And that's where the understanding possibly changed that they need to move towards more, a deleveraging mechanism, which factoring provides an off-balance sheet solution, right? With especially on a without recourse or partially without recourse basis, and that's why people, started appreciating that product, especially in the developing economies like India. People's perception about factoring changed. That is, if a factoring can provide deleveraging mechanism and also and also a risk mitigant besides being financing, why to continue with the traditional banking facilities only? And that's where we saw the demand from most of the customers, what we have seen today, increase towards factoring, and that's where our turnovers have gone through the roof despite the situation being so challenging across the world. So that's where the change is happening, and I believe change is for good. And in India, factoring has been, there for since 1990s. However, it never took off because there was easy accessibility and understanding of factoring was not there, and accessibility of finance was there much on the traditional means of finance. And over a period, now people are realizing that okay, finance is important, but optimized financing is even more important, and that's where people are moving more and more towards transaction bank facilities, which include factoring, and that's where the growth is. What you and I are seeing in the Indian markets, and I'm sure that is the situation which is prevailing across the world. I'll just share with you some numbers which we saw early from FCI. In 2020, the numbers dipped to an extent of possibly one third what we saw in 2019. The numbers dipped in 2020 with almost 33% or so. In 2020 again, 2021 again there was a growth, and 2022 I'm sure what we have seen the growth of almost 45 to 50% in our turnover across our business at least, and that's what I see that getting replicated across FCN as and when those numbers gets released. However, yes, there might be a little change in the dynamics of the cross-border trade, where the turnovers would have possibly the business volumes could have reduced. We being providers of international as well as domestic factoring, possibly our turnovers remain constant or grow to a large extent. But I believe that there might be a little changing situation across the world, and but do I again, because of these two situations, the growing reduction of appetite by the banks across the world, and credit squeeze, and also because of the risk perception changing again, possibly there will be a shoot up of demand on the factoring like products. It will also be important to note that how the demand at the end customer changes, which will drive all these figures. So yes, it's important. We have seen the growth in India. The domestic market in India remains pretty much strong. Very strong numbers are coming out from all the economic indicators which are coming in, not just GDP but also PMI index, which we saw in domestic, which is moving in the range of 55 to 57, which means that the investment scenario still continues to be positive, strong positive for Indian manufacturers and suppliers. So that remains from the domestic point of view. Exports may see a blip down, but definitely as the situation changes and people adapt, I see the second quarter or possibly second half of 2023 to be a definitely much better position than today.
Right. Thanks, Ravi. So that's a good development. Even the crisis give us opportunity to learn new things. So it's sometimes crisis is also good. So all our exporters now they learned how to manage situation in the tough condition. and that's the reason now the supply chain and factoring solutions are growing in India currently. So we have a question from audience, Ramanathan. Dear panelists, why is it difficult to obtain acceptance on invoices from debtors? Why do buyers discourage follow-ups from factoring companies? Ravi, would you like to take?
No, so I believe it's difficult, yes, because what is the aim of factoring and supply chain finance is to ease the finance and bring in the ease and convenience for both the sellers and the buyers. And if we insist on acceptance of each and every invoices, then it becomes, you're defeating that basic purpose of bringing in ease. Yes, in a supply chain, the anchor-driven supply chain model, it is very much possible because anchor is driving the initiative, and that's where it becomes much easier. However, when we see situation, we need to see situation from a win-win situation perspective, that what is it in it for the supplier who is possibly out of funds because there is a credit period involved. uh, so a win-win situation for the supplier is that he needs money as early as possible, possibly immediately on shipment. So how do we meet that? So how do we fulfill that gap is something which we need to see, rather than seeing that only invoice acceptance. So that's the gap which needs to be filled in. That if the buyer and seller relationship is strong, there has been historically reduced dilutions, then acceptance of invoice is not really a must-have requirements. But in a supply chain finance sort of a business where the financial aspect is much more entrenched, this is a possibility. Because we do not want the supplier to be out of funds for the period till the buyer accepts that invoices. In some situations, it can go on for days or possibly months before the buyer actually accepts the invoices. So we need to see from customers' point of view what as financiers we bring to the table for them, how we are providing a relief for their working capital, and how much we are able to cover that gap is much better. Now, to the second question, that why do buyers discourage follow-up from the factoring companies, is possibly, there are internal requirements, compliance requirements. Whatever said and done, even though the factor actually steps into the shoes of the seller. So in such a situation, as because of assignment is considered as a true sale, so the factor is actually stepping into the shoes of the seller. Okay, but in a global situation, the buyer does not really see that change in the dynamics, and they see that the factor is a third party. So how do you manage that sort of internal requirements? So it's an understanding gap, and that's where we see that some buyers, global buyers, discourage that follow up from the factoring companies. There are other aspects where other customers, other buyers who encourage. In fact, by being there as a factor, it brings in discipline in the payment mechanisms also, because I believe it's a positive aspect which many global buyers follow. Allow those follow-ups. They are more cooperative. In very few situations, I have seen that they discourage follow-up. Primarily, possibly in some localized environments, they do not allow, because they see that the factor is a third party, not really the seller who's doing those things. So that's why possibly some situations where they discourage such initiatives. I hope I could answer, Ram, for you.
Yeah, absolutely. Michael, would you like to add further?
Well, just to say that in reverse factoring, of course, the arrangement is made through the buyer, and the buyer then understands that he has to be, as part of the arrangement, he needs to accept the invoices. And so it's pretty much an accepted part of the arrangement, and a certain amount of automation takes place there. And in some situations, if the factor doesn't receive acceptance, then it's accepted by default. So a certain period will be set up by which, if the factor does not receive an acceptance notification within that time period, then it will be deemed to be accepted. So, and I'm not quite sure, in the case of factoring, I'm not quite sure why every invoice needs to obtain an acceptance from the buyer. That's not the case in many markets. I guess in most cases it doesn't come up as much of an issue as far as I understand. So I don't see it as a real big thing. Yeah.
Sure. Thanks, Michael. And we have another question from an audience. Vinod Chaubey. Hi, Michael. It has been 1 year the war is on. World has been impacted due to this development in Europe. Can you say that market economy scenario shall remain the same and the world will have to learn to do business this way, ignoring the war? There is really no sincere effort to stop the war. Which economies, geographics have benefited from current geopolitical scenario?
It's difficult to know which economies and geographies have benefited in the current scenario. Certainly, in terms of the impact on energy and oil, some markets have benefited from that. In the divergence, if you like, of trading positions in energy. But as we mentioned before, the whole situation at the moment with the war is one of great uncertainty. We could see patterns developing with COVID and the pandemic. We could begin to see the world coping and dealing with that and responding to that crisis. With the current situation, with the conflict in Europe, we can't see that. We don't know what's going to happen. There's much more uncertainty. But as we said before, the world will begin to live with it. It's not the first conflict we've had in the world. It's not. We've had much longer conflicts that we've lived with and dealt with, and the immediate reaction when something like this happens, and it was really quite sudden when the invasion took place in February, the immediate reaction by the world, by businesses, by consumers is, let's be cautious. Let's perhaps hold back on spending, maybe some major spending, and let's see what is going to happen, what the consequences of this invasion, what it's going to mean to the world. But after a period of time, people will begin to understand that okay, this is going to be a long-term thing. We have to live with it, and life has to continue and carry on. We can't withhold our spending forever, and things will begin to normalize, and a certain amount of acceptance will be there in economies around the world. And as we said before, if the conflict finishes, then there will be an acceleration of that process back to normality. So things, one way or another, things will get better than they are at the moment. I'm fairly sure of that.
Right. Thanks, Michael. Hope Chaubey question answered. And we have another question. Thank you for your insights. My question to Michael: based on your market inputs, which are the industries you expect to grow faster in 2023, especially in USA and Europe? To Michael.
Okay. Again, it's a difficult one because of the economic climate, and it's very difficult to say 2023. I mean, you've got to look at a longer period than that. I think it would be very difficult for anybody to predict who are going to be the winners and losers in 2023. In the whole scheme of things, that's a very short period, and it's a very uncertain period. But I would predict an upturn again in technology at some point. We've seen a big downturn in terms of technology in recent months, and a lot of retrenchment, and a lot of reduction in stock market prices in technology. I think that'll swing back at some point in the next couple of years. It's a very difficult one to be precise as to who are going to be, which industries will grow fast in 2023. I mean, you can look at some obvious ones, like there's a huge amount of military support and armament support going into Ukraine at the moment. Those sectors are going to do well. They're coming from the US, they're coming from Europe, and other places. And so, okay, any industries that are connected to that will clearly do well. I don't know, Ravi, what can you add to that?
Well, surely, that's one of the huge growth element which is coming in. Of course, yeah, no change in the season or change in the volatility brings in complete downfall for all sectors altogether. So definitely, war is also an harbinger of growth for the companies involved in the weapons and possibly other things. It's not good, but definitely there is something which is going on, growth in that space at least. And as Michael rightly says, whatever is connected with the arms space, and what do we say? It's not only about the armaments, because armaments are not just a product; it's an assimilation of possibly 25,000 things, be it electronics, be it chips, be it components, various components, not just the actually ammunition which is talking about, because entire armaments are conglomeration of or consolidation of various equipments, components being put together. So electronics, I see, is a huge growth segment. The other industry which I see, the sector which I see immediately boosting because of the oil crisis, possibly an energy crisis, there will be a huge move away from the fossil-based economy, and that's where we'll see solar investments in solar, possibly wind energy and other energies, other renewable energies. That could be a huge boost. And what we are seeing already, in fact, I'll just share some numbers which are there in the news today. In India itself, there is a huge move towards EVs, electronic vehicles, from fossil. And 2022 itself saw a sale of more than 1 million vehicles all across segments, sectors, be it two-wheelers, four-wheelers, 1 million plus vehicles in 1 year itself being sold under EV category. So that's a huge growth in a market like India, and I'm sure that situation will also prevail across Europe and US. Maybe less in US because US has their own oil, and that could be little less, but definitely Europe, that could be a huge move, and we are seeing that in the news also. What could be other recession-proof economy sectors rather is food. Food is going to be relatively recession-proof, I see, because food you're going to eat, people are going to eat throughout the year. Maybe the patterns may change in which subcategories of food will change, possibly not so high value ones, possibly the regular ones will change the dynamics. We have seen the changing dynamics. Ukraine was the food grain producer for the world, right? And that is going to change the corridors, the trade corridors, possibly. But food is going to prevail as a growth segment, growth sector. Retail to an extent, because people are going to wear clothes, right? And we saw in during this oil crisis also, if the oil is less, energy production needs are less, then people are going to rely more on on clothes, right? There's going to be huge investments towards that, possibly to provide relief against the bitter winter, which is the inmost part of the European countries. So that is going to continue to sustain, and for the immediate short term. And over the period 2023, I hope the war situation resumes back. But these are the sectors which I could see that could immediately gain in 2023 and continue to grow in the short term. But definitely, as I said, things change and quite dynamic at this point of time, and this may change over next quarter or possibly half year as well.
Yeah, I think it's difficult to focus on 23 particularly, but slightly beyond that, things like as Ravi said, electric vehicles, and also suppliers to that sector, like battery technology and raw materials like lithium. We'll probably see significant increases. But yeah, very difficult to predict the next few months.
True. So yeah, we have to wait and watch. So then I think the first quarter results will show us some more clear path how it's going to be. Yeah. So there is another question for Michael. Factoring and SCF is happening through various modes such as platforms, two-factor arrangements, fintech, etc. And what are the key items exporters need to take into consideration while selecting suitable mode of receivable finance arrangement for them?
Well, again, it's difficult to give a sort of broad answer to this because it depends on individual circumstances. But cost is an obvious one, but cost isn't everything when you're looking for a provider. In my experience, quality of service is very, very important. In many cases, cost is not as sensitive as many people think. Quality of service is very, very important, I think, particularly in all business relationships, but particularly important in receivables finance relationships. And in my experience, if you're getting a good service and you have a good relationship with your client, those clients will stay longer. And in those situations, it's not as price sensitive as many people think. Of course, if your client is working on very small margins, then price sensitivity comes into it more. But the relationship aspect is very important. Other things, speed of service might be very important. Setting up an arrangement quickly might be very important. And flexibility might be important. Some of the larger players, larger practitioners may have limited flexibility, whereas fintechs may be more adaptable. Fintechs are nimble, they can act quickly, there's greater use of technology, of course, and all these things can mean smoother flows in terms of the service, less friction. But fintechs can be more expensive. That's the other side of the coin. So it depends on individual circumstances, but I think those are the areas to consider and to look at.
Right. Thanks, Michael. And Ravi, there is a question for you. And there is, in a huge way, the digitization was going on in India for the last 2 to 3 years. And what are the things India factoring changed after digital revolution in India? And how do you see year 2023 for India factoring?
No, definitely digital is a new means. Obviously, we saw during pandemic and after that. In fact, before that itself, the move towards digitalization has been there, and we saw the growing need for bringing in the all connecting dots together in the digital environment. So that's an ever-growing requirement, and definitely as India factoring also we are quite keen and quite adept in doing these, addressing these situations. We saw during the pandemic that we moved a huge element of our business towards digital capabilities, and where clients could submit their invoices online rather than submitting in person in physical copies. So that has been the initiative and driver. As we go about, I think we have a complete transformation which is happening in our internal platforms. Also, we are going in for the new investments, which is an expensive investment, but I see it as a huge positive investment towards providing more convenience to the customers, providing ease of access, and also bringing in operational efficiencies at our end. So there is a huge initiative towards that, and definitely towards mid of this year, we'll see the fuller implementation of these initiatives towards moving towards digitalization and bringing in the convenience. What we are focused towards is providing an end-to-end solution to the customer without having that sort of a manual interface in that transaction processing. However, it is also equally important to bring in the human element, because all these things are relationship based, because we are not talking about a retail sort of an environment where you log in or possibly use your phone to completely transact, because the specific requirement might be different than what the retail customer goes through. So definitely a huge human element is there in the corporate sort of an environment, which we continue to provide as well. And that's where we believe that a hybrid approach, which will provide digital as well as in-person approach, a mixture or hybrid approach towards that, will provide the best possible scenarios for our customers in the Indian markets.
Okay, that's great. And there is a question from audience. Dear panelists, why the buyers, even highly rated buyers, are not encouraging payment follow-ups? I think, and even soft reminders from factoring companies. I think the similar question recently we have answered. I think this is a it is more specific to buyer to buyer. So we'll go on to the next one. There is another question from audience. How are Indian factoring companies faring to fintechs, foreign trade finance companies operating in India? Ravi?
No, so yeah, sure. So I think the fintechs, as Michael brought in, that they bring in the agility and other other convenience aspects. However, they can be I firmly believe that the compliance aspects across the world are growing. The regulatory aspects for most of the banks and financial services sector is the most important pillar for years to come, and now also it is extremely important to mitigate against any risk situations of AML and other aspects we have seen. And that's where the regulations are getting stringent, and as much as possible, who are the regulated entities will prevail over a longer period of time. Fintechs possibly can provide digital capabilities to the banks, the traditional banks, NBFC, non-bank finance companies, and other regulated entities. They can be the enablers of that trade rather than being an end in itself. So I see the prevalence growing, and there can be more convergence rather than a threat or a competition perspective here on. Synergies to be positioned between fintechs, non-banks, banks, and the traditional operators is the best way forward, which could provide the best of capabilities, that is ease, convenience, digital, and other means from fintech possibilities, and possibly even on the risk assessment, monitoring, and whatnot on the tech space, and the risk-taking appetite, cost, and possibly coverage from the bankers or the non-banks or traditional financiers point of view. So that's why I see possibly emergence of the more of a consolidation, convergence, partnerships, opportunities to prevail.
Yeah, and I think that's particularly prevalent for India. I mean, India's economy is doing so well compared to other economies, and I think India is poised for very significant growth in this sector. If you look at the GDP penetration of receivables finance in India, it is well under 1%. Whereas if you look at the penetration in other markets, mature markets, it's many of them are well over 10%.
Yeah.
So that's a very simplistic way of looking at it. But if it's any kind of guide, even a rough guide, one could predict that there is significant future growth for this sector in India. And of course, when you've got a rapidly growing economy and sales are increasing among businesses in that economy, then receivables finance is a great tool for use in that situation, because the the financing grows with in line with sales growth. So it's a great tool, a great service for businesses in a fast growth environment. And India, more than any other economy, any other major economy in the world today, I think is being seen as having such great prospects in the near future for continued growth and development. So I think we'll probably see more interest from foreign investment and foreign factoring operations coming into India. I think the environment for growth of factoring and receivables finance in India has improved in recent years. So I think there's a lot of positivity in the future for India in the near to medium future and beyond, of course.
Yeah, that's great to hear. Thanks, Michael. And tell us, what is the role of BCR Publishing in supporting global receivable finance business the last 30 years?
Okay. Well, I've got to, in answer to that question, I've got to try and make it not sound like a sales pitch for BCR. But I think the role of BCR is really, well, there's more than one role. I think it's very important for people to come together in this sector. And so we put on events, as you know. Ravi has attended many of our events in the past. And I think face-to-face meetings are extremely important. And I think it's much more difficult to achieve cooperation, strategic alliances, and business relationships if you don't know the person, if you haven't met that person on a face-to-face basis. It's not the same as a telephone call. It's not even the same as a Zoom or Teams call. Getting to know someone over a beer or a cup of tea or coffee, these are the way that relationships are developed. And once you have those initial developments in place, then it's much easier to do business with those people. And that's where conferences are very, very important. We also disseminate information through our publications, our market reviews, and we also have a news site which publishes news about the world of receivables finance on a daily basis. And these services and what we do are particularly important in this kind of sector because the sector is rapidly developing and still rapidly growing in many, many parts of the world. And where you've got that element of relatively rapid change and evolution going on, people need to know about those changes. They need to know what companies are doing, what are their markets doing, what new products are being developed, what new regulations are coming in, movements in terms of senior people, new business that is being gained by other operators, and new technologies. I mean, this is not, the receivables finance is still a relatively new business, a new sector in the world. And there are rapid changes going on compared to other sectors. And as a result, to keep on top of those changes, you need to be aware of the kind of things that we're publishing in our publications and on our news site. And the sort of content that we have at our events is all about change and opportunities and concerns and issues. And as I say, there's a lot of that going on in this sector. It's a sector full of development, and it makes it interesting for everybody, but it also provides opportunities for everybody. And the best way of understanding where those opportunities are is by communication and market intelligence and meeting people in the industry. So that's what we do. That's really what we're about in our business. And sorry, you meant also you meant about over the last 30 years. Of course, there's been huge change over the last 30 years, and we've had to change the way we operate in our business over that period. But if you go back 30 years, one of the big changes has been, of course, technology. I mean, 30 years ago, in the UK, for example, typical factoring operation every day would receive a pile of hard copy invoices, and someone would have to type in all the details of those invoices into their system. Of course, now you have very fast data transfer, you have digitalization coming in, use of APIs, extraction software. So banks, factors can extract not only sales ledger information from the client system, but also other accounting information, which will help them make their credit decisions much easier and much more accurate. You've got anti-fraud systems that are available now, which were not available in the past, and other developments that have been going as well, major developments. We see larger businesses using receivables finance than we've seen before. It's still primarily for small and medium-sized businesses, but larger businesses are now using receivables finance. 30 years ago, most businesses using factoring receivables finance would have had a turnover of less than, say, $1 million a year. Larger businesses would have had turnovers of maybe $3, $4, $5 million a year, but now we're seeing businesses using receivables finance turning over hundreds of millions of dollars a year, and that's on the seller side. With reverse factoring, of course, arrangements are made with buyers who are multi-billion-dollar companies. And many of their suppliers are large companies turning over hundreds of millions of dollars. So the whole industry has become much more mainstream. And our services, BCR services, have adapted to all those changes in terms of the provision of information that we provide. And to some extent, in the early days, it was much more about education, because a lot of businesses, even a lot of banks around the world, weren't very familiar with factoring and receivables finance. Now it's more about strategies and new products and those kind of new markets, those kind of developments that we're looking at. So yeah, in a nutshell, that's pretty much what we do.
Right.
So I would like to add, I echo the views, BC, because for me personally, being in the business, my go-to, section whenever I come or face some challenges on the new to market or new buyers, market possibilities, new countries, is the BCR World Yearbook. So that's why I immediately go out, check the information which is there on the, and these information is provided by the specialists from the various countries, various members of FCI, and possibly the banks leaders in that space, and they bring out the aspects of what's happening in that market, what's the regulatory changes. So that's a go-to book for me whenever we want to do a new business, new market opportunity, and obviously the information which comes about on the regular basis from BCR publication. That's where it's an easy assimilation, where you can use that sort of an information that what's happening, because the world is so changing, so changing so fast, that all information is all what is the key determinant of the success factors, you can say, about how you want to grow your business, and that's what BCR provides.
Thank you, Ravi. And another point worth mentioning, actually, and something we're looking at more closely is the receivable as an investable asset class.
Yeah.
There's a lot more interest now in investing in receivables as an investable asset, and we've seen that trend develop probably since the banking crisis, 2008, 2008, 2009. It was there before that, but it's been increasing quite rapidly since then. And there's quite a big movement to look to develop this whole area and make it easier for investment in receivables as an asset class. And that's going to help the sector as well. There's a lot of banks that want to find easier ways of getting these assets off their balance sheets and distributing risk. And for independent players, funding independent factoring operations is an issue around the world, and is one of the constraining factors for growth and development of independent factoring operations. So the development of the investment on this side will help independent factors, particularly around the world, considerably. And that's something which I think is going to take off in the not too distant future. And in fact, we're doing an event on it in London in March on exactly that topic, the development of not just receivables, but trade finance assets in general, the development of that as an investable asset class. So we think that's going to be a very interesting area in the coming near term, actually near to medium term.
Okay, that's great. Fine. So we are moving to the end of the show, and thank you, Michael and Ravi, for joining us and sharing your insightful thoughts on various trade finance, market trend, and all the export-related matters. Thank you so much for joining in.
Thank you.
Thanks so much.
It's been a pleasure.
Thank you. Thanks, Michael.
Thank you all. Hope all your questions were answered. And if you want to know more about factoring or India factoring, you can visit our LinkedIn page or YouTube channel, or you can directly visit our website and to connect our direct numbers. I'm signing off. We'll be back shortly with another chat show with an interesting topic. Thank you.